Okay, so here's the review of the lecture that we had last night. In Chapter 12, we're learning about three types of investments. And here's the document that I'm going to actually review and send to you via Blackboard. So we have three types of investments. The HTMs is the held to maturity, the trading securities, and the available for sale securities. And we're learning how to report each of those. Considering that each of the three investments are lack of sufficient influence type of investments, then we are going to report them in the following ways. So held to maturity investments are investments that management has decided that they have the intent and the ability to hold until they are mature or until the maturity due date. Okay, and we report these at amortized cost. So I made a little link right here that you can click, and it should take you to the HTM section of the document. So in this section, the HTM is the example that's in the book, and what I did was just kind of expound on what was in the book. It's $1 million bond, it's 10%, it's 10 years, paid semi-annually. The market rate for a similar bond is 12%. So we need to know that to figure out what the effective interest rate is in order to determine what our interest revenue is going to be. So, and here are the other terms of that bond. I went ahead and just labeled out, look at the present value of ordinary annuity of $1 table to find the principal present value. We're going to go down 20 periods. It's 20 periods because it's a 10-year bond. Interest is paid semi-annually, so 10 times 2 is 20, so we got 20 periods. We go across to the 6% column because the effective interest rate is 12%. And then for the principal, then we'll do the same thing with the present value of $1 table. Get those values, and we'll come up with this amount here is the present value of the bond itself. So I went ahead and did an amortization schedule, a full amortization schedule, so you can see here's the interest payments here, the interest revenue, which is carrying value times the 6%. Here's our discount amortization, and unamortized discount is here. So for the 20 periods, you can see how that all plays out. We add the discounted amount to the carrying value to determine what our next carrying value will be. We multiply that by 6%, and that will give us our interest revenue. Okay, so here are the journal entries. This journal entry here on January the 1st is the purchase. So we're going to debit our investment account for bonds for $1 million. We've figured out what the discount is going to be. We did our amortization here. And so we're going to credit the discount on bonds. And then our cash payment for the bonds would be the present value amount that we calculated from the tables, from the factors from the tables. June 30th, which would be our first semi-annual interest payment, they paid us $50,000 interest. We booked the discount on bonds, which means that we're actually decreasing this entry here. So our account, we have $114,699 in it. We're going to debit that account, and it has a normal credit balance, so we're actually reducing that account, just as it shows on the amortization schedule. So with this, now we have this amount in that account. And then, of course, we book the interest revenue, which is going to be the entire effective interest amount. Here, the next 6 months will be December 31st. We do the same thing, but with the December 31st amount, which will be this amount, and we make those journal entries the same way all the way through the entire bond issue. And then, of course, this is the journal entry here. When they actually pay us, they're going to pay us $1 million, and we'll reverse that, and we'll have investments on bonds will be the credit, and then they will give us $1 million in cash. Okay, let's go back up to traded securities. Traded securities are those that are held in a trading account and reported as fair value with unrealized gains and losses actually reported in net income. Okay, so if we are a company that closes every month, then we will report that every month if there's anything to report. And we're going to see an example of that here. So you click control and then it'll take you down to trading securities. I did a little explanation that I thought was a little bit more plain than what was in the book, but in short it's the same thing. Securities that we intend to hold for a very short period of time to raise capital for whatever reason. We don't have to have a static reason for doing it, but these are not volatile stocks. They're stocks that we do intend to sell. We're going to hold them for whatever period we determine that we're going to hold them. We account for these as current assets, and you're going to see at the end where you go to look at how the financial statement presentation should look. Although we record them at cost, of course. You saw the purchase entry. So we record them at cost, but any adjustments that we have to make based on fair value or market rates, then in subsequent periods we will make those adjustments and book it to the income statement. And I did put why do you think that we do that? Unlike all the other assets that you're used to accounting for at historical cost, these are not meant to be used for operations. They're meant to be used for other purposes like raising capital and things like that, which normally most businesses are not in the business of raising capital. So they're not treated like operational assets like PP&E, real estate, and all of that. So therefore, the fair value piece is relevant to what we're trying to accomplish with these securities. So here is the trading example. Heavenson Incorporated purchased the following January 1st. Walmart stock, Procter & Gamble stock, and Tyco stock for these amounts. Okay, so we book the purchase here. For January 1st, we book an investment account for Walmart. One for P&G, one for Tyco on the debit side. That creates our asset. And then, of course, we pay $4,500,000 for them in cash. December 31st, Walmart declared and paid a $50,000 dividend. Procter & Gamble nor Tyco declared a dividend, which created the following entry. So we got $50,000. That is investment revenue, $50,000. Next, Heavenson accountants announced fair value adjustment requirements. Walmart stock valued at $1,250,000. Procter & Gamble $2,050,000, and Tyco common stock $1,250,000. Okay, so here is the schedule that we would use. Let's see if you can see. Yeah, here's the schedule that we would use to determine what our entry is going to be. We're not going to make a separate entry for these stocks. Okay, so what we would do, here's we list out the security. This is what it cost us. This is the fair value at whatever period this is, which would be December 31st, 2012, in the year. Here's what the fair value is, the totals. Here's the adjustment. So this went up $250,000. Procter & Gamble went up $50,000, and Tyco actually decreased $250,000. So our net fair value is going to be $50,000. So we didn't have anything else in the account, and now we're going to make a $50,000 adjustment to fair value, a positive adjustment. So based on the information that you're in, Heavenson needs to make a fair value adjustment of $50,000, creating this entry here. Okay. So the fair value adjustment, if it is up, it's going to be on the debit side. Gains and losses, if it is a gain, it will be on the credit side. We are, remember, you're a revenue account. This is, in essence, it works like a revenue account. And also, this is for net income. So that's very important because trading securities go into net income, and you'll see why that's important in just 1 minute. So this is an entry to record the gain. Okay, due to the condition of Tyco stock, Heavenson decided to sell its stock, its Tyco shares, on January 1st. So that would be after the end of the year close. So they sold it for fair value, which we know fair value was $1,250,000. So they got cash of $1,250,000. They did incur a loss, so we debit our loss account, $250,000, and then we clear the asset account, $1,500,000. So that stock is sold. Okay. So back to available for sale. My phone is ringing. Available for sale. Also reported at fair value, but we report this as other comprehensive income instead of net income. Okay, the methods for reporting when the investor does not have significant influence over the investee. So let me go back. Let me go to available for sale first, and then we'll get back to that. Let me click that. Okay, so these securities are purchased not for active trading and will not be held to maturity because they don't have a maturity date. So neither one of these could be held to maturity mainly because they're not debt instruments, but there's no maturity date. So it can't be an HTM. Plus, normally we know in advance if it's available for sale or a trading security. The only difference between AFS and trading securities is that we report the unrealized gains and losses in other comprehensive income and not in net income. And the reason for that is because these tend to sell very, very fast, and the prices change very fast. So these sort of marketable securities normally will be in some sort of sweep account because they'll be included in whatever day trading operations your company may have. So they will change a lot. But which is the reason why we don't want them in net income. It's because remember we were talking back, I guess, chapter 5 or 7, somewhere along in there, about the presentation of net income to outside users. We got to remember that these financial statements are not for our use; they're for external party use. Therefore, we don't want it to look like we can't control our income. So AFS is not included in net income. Okay, so here, close attention. If you need to refresh on other comprehensive income, go to chapter 4. That is the chapter that has an explanation of what that is. Net income and other comprehensive income are both included in the comprehensive income statement and show the changes in shareholders' equity. Okay, net income is close to, and I spelled retained earnings wrong, is close to retained earnings, and OCI close to accumulated other comprehensive income, which is the end of the balance sheet if it's a small company, and could be on its own separate statement, which doesn't matter. Okay, so a lot of difference. AFS is generally a method used to hedge liability for fair value. If you remember, GAAP allows us to book our liabilities at fair value. Most companies do not, but those that do book at fair value, depending on what their debt issues are, they may hedge fair value due to whatever is backing the liability. So, and that will come in when we have derivative type things that are out there. So if somebody has invested in your say your notes receivable, and then say most of your receivables are in the diamond market, and let's just say the diamond market goes up, then that liability's fair value would change because the diamond market is higher, so your collateral is higher, so your risk is lower. So we won't get into hedging and that kind of stuff, but that's normally what it's used for. So therefore, we don't need it on net income or any of the other public statements. Okay, so all the journal entries for AFS and traded securities are the same. Okay, with the exception that when we do the fair value adjustments at the end of the year, then we book it to OCI and not net income. That's the difference. Okay, and normally these journal entries are only made at the end of the year, unless there's some policy where the company actually closes. They do a hard close every month. Then we would do it then, but it is an end of period adjustment. Okay, so lastly, take a look at page 668 and at the illustration 12.8, and you'll see the comprehensive income statement and how the realized gains and unrealized gains are there. Also, the balance sheet piece for available for sale securities. Also, where the accumulated comprehensive income would go, and the statement of cash flow. Okay, so take a look at that, and we will start back up there on Tuesday. I wanted to make just one more point out about fair value adjustments. If we sell trading security or a if we sell a available for sale security and we have booked a fair value adjustment for unrealized gains and losses, then we need to reverse that. And that just kind of makes sense, because now whatever, we would actually reverse that entire entry. So whatever's sitting in our unrealized for that investment, we will reverse the entire thing out. And then at the point of sale, we will actually book the realized gains and losses for this security. I just wanted to point that out. It just came to my mind just now. So take a look at this document. Hopefully it will help with your homework. And make sure you at least read from the beginning of the chapter through page 668. And we will start up from there next week.